Welcome to the deep dive. Today we're cracking open a book that's less about predicting the stock market and maybe more about building the mental strength to navigate it. We're diving into Benjamin Graham's absolute classic, The Intelligent Investor.
It really is a classic. Warren Buffett called it by far the best book about investing ever written.
Yeah.
And our source material today, well, it pulls right from those timeless principles.
Right. And our mission here is to sort of cut through the noise and pull out the core wisdom. We're talking about what Graham actually means by being an intelligent investor. And hint, it's not really about your IQ score.
Not at all.
We'll try to get crystal clear on that crucial difference between truly investing and just, well, speculating. We'll touch on how you even begin to look at a company's numbers, how to manage risk, and maybe most importantly, how to stare down the biggest obstacle most investors face.
Yeah, because the source really emphasizes this isn't about, complex math or trying to perfectly time the market. It's much more about having a sound intellectual framework.
Yeah.
And just as crucially, the emotional discipline to actually stick to it, especially when things get chaotic.
And the promise, pretty much direct from the source. Follow these principles and you're virtually guaranteed not to get a poor result from your investments.
Mm-hmm. And you might even find ways to profit from the markets. Let's call it occasional irrationality, Mr. Market, as Graham puts it.
Mr. Market, we'll get to him. Okay, so let's unpack this idea first. What does it mean to be intelligent in Graham's view?
Well, Graham makes a really critical point early on. An intelligent investor isn't defined by a high IQ. It's, he calls it a trait more of the character than of the brain.
Character. Okay, so what does that mean practically? What traits are we talking about?
It means being patient, first off, disciplined, genuinely eager to learn, not just looking for hot tips. And maybe the hardest part, being able to harness your emotions, fear, greed, those big ones.
And thinking for yourself, not just following the herd.
Exactly. Thinking independently, rather than just getting swept up in the crowd's mood. It's about having that internal strength to stay your course.
That really reframes it, doesn't it? It's less about being some kind of genius and more about grounded self-control.
Yeah.
And speaking of grounded, one of Graham's most foundational ideas, the margin of safety.
Yes, the margin of safety.
Yeah.
Crucial concept. Think about an engineer designing a bridge.
Okay.
They calculate it needs to hold, say, 100 tons. But they don't build it just strong enough for 100 tons, right?
No, that would be crazy.
Exactly. They build it to hold maybe 200 tons, maybe even more. That extra capacity, that buffer, that's the margin of safety.
So in investing, you're not just crossing your fingers, hoping everything goes perfectly.
Yeah.
You're deliberately building in a cushion for when things inevitably don't go perfectly.
Precisely. It's about buying an asset. Could be a bond, could be a stock for significantly less than what you've conservatively figured out its real intrinsic value is. That gap, that difference between the price you pay and your estimate of its true worth, that's your buffer. It protects you against mistakes in your own analysis, or just plain bad luck, or, things you couldn't foresee. It's your first line of defense against losing your capital permanently.
That makes so much sense. It's really about risk management first, not just chasing returns. Okay, let's tackle something fundamental, though. Well, Wall Street language often seems designed to confuse the real difference between investing and speculating.
Yeah, this is a huge distinction for Graham. And it's simple, but really powerful. A speculator, in his definition, is primarily focused on predicting market prices.
Trying to guess where the price will go next.
Basically, yeah. Profiting from short-term price changes. They're trying to time the market, buy low today, sell high tomorrow, purely based on those price movements.
Trying to ride the waves, essentially.
That's a good way to put it.
Yeah.
An investor, though, is focused on something different. They're acquiring and holding suitable securities because they represent ownership in a real business, a piece of actual productive assets.
So for the investor, market ups and downs are secondary.
They're important, but mainly because they create opportunities. Times when prices fall below intrinsic value, that's a buying opportunity. Times when they soar way above value, maybe that's a selling opportunity.
But I hear everyone on TV, in the news, they call pretty much anyone who buys a stock an investor.
And Graham calls that the easy language of Wall Street. It just blurs the line. He's actually quite firm about it. Stock trading, trying to make quick money from price swings, that's explicitly not investing. It's speculation.
So is speculation always bad then? Should you just never do it?
Well, the source acknowledges that speculation can be fascinating, can even be fun, when you're winning. But Graham gives very clear advice if you do choose to speculate. First, use only a small part of your total capital.
Keep it separate.
Absolutely. Strictly separate from your investment funds. And this is key. Never add more money to your speculative pot just because the market's going up and you feel like you're on a roll.
Avoid doubling down on luck.
Right. In fact, that might be exactly the time to take some speculative profits off the table.
So the absolute rule is keep your speculating brain completely separate from your investing brain. Don't mix them up.
Absolutely. Never mingle the operations or even the thinking behind them. And this whole idea, this separation of mindsets, that's where the famous Mr. Market analogy comes in.
Mr. Market. The ultimate emotional roller coaster partner.
Pretty much.
Yeah.
Imagine you co-own a business with a partner named Mr. Market. And every single day, he shows up at your door. Without fail.
Okay.
And he tells you what he thinks your share of the business is worth that day. And he offers to either buy you out at that price or sell you his share at that price.
But he's moody.
Extremely moody. Some days he's just euphoric, sees only blue skies ahead, and offers you a ridiculously high price. Other days, he's utterly terrified, sees nothing but doom and gloom, and offers to sell you his share for practically nothing. Pennies on the dollar.
And the key insight is you don't have to deal with him. You can just ignore him.
That is the absolute core insight. By refusing to let Mr. Market's crazy day-to-day emotional swings dictate your actions, whether you buy or sell, you flip the script. You turn him from your master into your servant.
Okay. Oh.
Well, when he's feeling irrationally optimistic and offering you a high price, maybe you consider selling to him. When he's panicking and offering things dirt cheap, that's your opportunity to buy value from him. The source points out, even during market bubbles like the dot-com frenzy, when tech stocks were going nuts, Mr. Market wasn't just destroying value everywhere, he was actually creating value somewhere else by making those less glamorous old economy stocks cheaper and cheaper because everyone was chasing tech.
Wow. Okay, so understanding Mr. Market is crucial for dealing with the external world of investing. But the source really hammers home that the biggest danger isn't Mr. Market. It's closer to home.
Yes. This is, I think, perhaps the most profound psychological insight in the whole book. The investor's chief problem, and maybe even his worst enemy, is likely to be himself. As the source puts it, kind of paraphrasing Shakespeare, the fault, here, investor, is not in our spares and not in our stocks, but in ourselves.
Because our own emotions just short-circuit that rational framework Graham talks about.
Completely. When the market's soaring, greed kicks in. It pushes us to buy things we probably shouldn't at prices that are way too high.
And when it crashes,
fear takes over. It either paralyzes us so we do nothing, or worse, it drives us to sell perfectly good assets at the absolute worst possible time, locking in losses.
And the source mentioned some psychological research that backs this up, didn't it? About how we feel losses.
Yes, absolutely. Pioneering work, actually, by psychologists Kahneman and Tversky. It's cited in the commentary sections of the book. They showed that the psychological pain we feel from a financial loss is more than twice as intense as the pleasure we get from an equivalent gain.
Wow, twice as intense.
Yeah. That disproportionate pain makes us naturally loss-averse, which explains why people panic sell during downturns, or why they're too scared to buy more when prices are low, even though that's exactly what an intelligent investor should be considering.
And even the way we frame the numbers can mess with our heads, right? Like focusing on big point drops instead of percentages.
Oh, absolutely. It just fuels unnecessary panic.
Yeah.
You know, if the Dow Jones drops 100 points when it's sitting at, say, 8,000, the headlines scream, "Market plunges." Sounds terrifying.
Yeah.
But really, that's only a 1.2% drop. The source uses this great analogy. Imagine a weather reporter shouting, "The temperature's plunging. It dropped from 81 degrees to 80 degrees.
Okay, that sounds ridiculous.
Right. It's the same 1.2% drop. But framed that way, it's obviously nothing to panic about. Looking at market moves in percentage terms helps you keep that crucial perspective, especially when things feel volatile.
That's such a practical tip. Just change how you look at the numbers to keep your head straight. Okay, so we get the core principles, the investing versus speculating thing, and this huge psychological hurdle. How does Graham suggest people actually do investing? He seems to offer different paths, right? Depending on the person.
He does. He basically categorizes investors into two main types. The defensive investor, sometimes called unenterprising.
Okay.
And the enterprising investor, also called aggressive.
Right. The defensive investor sounds like someone who maybe just wants to avoid major mistakes, get decent results without making investing their whole life.
That's exactly it. Their main goal is avoiding serious errors and losses. And they value, freedom from constant effort and worry. They need a relatively simple approach, almost an autopilot portfolio, because they don't have the time or maybe the inclination to constantly analyze individual stocks.
Okay, makes sense. And the enterprising investor.
This is someone who is willing to put in significant time and intellectual effort. They're looking to research and select securities that go beyond the obvious, widely followed ones.
Aiming for better than average returns.
That's the goal, yes. Better than average returns because of that extra effort. But, and this is a really important but, they must have genuinely developed the knowledge and experience to make independent judgments about investments. They can't just be following tips or hunches.
So you can't just decide you want higher returns and call yourself enterprising if you aren't actually doing the work or don't have the skills.
Precisely. The source really stresses this. Choosing between being defensive or enterprising is a major personal decision. It depends on your resources, your time, your temperament. And you absolutely shouldn't try to mix the two approaches or compromise between them. Pick a lane, basically, and stick to it.
Speaking of picking a lane, for that defensive investor, the source offers a pretty simple classic portfolio plan, doesn't it?
It does. Though it's helpful to remember the context. When the Intelligent Investor first came out, back in 1949, common stocks were actually seen by many as pretty speculative.
Which is kind of funny looking back, since they were about to go on this massive, decades-long bull run.
Right. It just shows how quickly perceptions can change. But then, that huge run-up also made stocks seem really safe, maybe at price levels that, historically speaking, were getting kind of high. So for the defensive investor looking for a simple program, Graham suggested maintaining a roughly equal split between bonds and stocks.
The classic 50-50 split.
Yeah, 50-50 is the simple starting point. Though he did say it could range anywhere between 25% and 75% in stocks, depending on market conditions and your own temperament. But 50-50 is easy to grasp. And the rule for managing it is mechanical, which is the key.
How does that work?
If stocks do really well and rise to, say, 55% of your total portfolio value, you automatically sell just enough stocks, specifically 1/11 of your stock holdings, and put that money into bonds to bring it back to 50-50.
Okay, and if stocks fall?
Same idea, opposite direction. If stocks fall to 45% of the portfolio, you take some money out of your bonds, 1/9 of your bond holdings in this case, and buy stocks to get back to that 50-50 balance.
So you're automatically selling a bit when the market is relatively high and buying a bit when it's relatively low without having to make an emotional decision about it.
That's the beauty of it. It's a discipline mechanism. It forces you to take some profits when things get pricey, and it actually provides comfort during declines because you know your plan involves buying more shares at those lower prices. It turns fear into a systematic action.
How do bonds fit into this picture for investors today? The types of bonds have changed, haven't they?
They have, yes. The specific recommendations change, but the core principles, safety, income, tax efficiency, are still key. Back then, U.S. savings bonds had some unique advantages. Today, for many individual investors, taxes are a really big consideration. Generally speaking, unless you're in a very low tax bracket, tax-free municipal bonds are usually best held in your regular taxable brokerage accounts.
Outside of retirement accounts like 401ks or IRAs.
Exactly, because putting tax-free bonds inside a tax-sheltered account like an IRA, well, you're wasting that tax-free benefit. The account is already tax-sheltered.
Makes sense. So taxable bonds go where?
Conversely, taxable bonds, things like corporate bonds or regular U.S. Treasuries, are generally best held inside those tax-sheltered accounts. That way, the interest they generate isn't taxed each year.
Got it. And the source also mentions a specific type of bond for inflation protection, right? Relevant today.
Yes, TIPS, Treasury Inflation Protected Securities. Now, they weren't around when Graham originally wrote the book, but the later commentary strongly recommends them. They're an excellent tool specifically designed to defend your purchasing power against inflation.
How should you use them?
The advice is generally to hold them for the long term because their market price can fluctuate quite a bit in the short term. And maybe consider allocating at least, say, 10% of your retirement assets to TIPS as a core inflation hedge.
Okay, that covers the basic portfolio structure for the defensive investor. But what about the enterprising type? Or even just someone who wants to understand what they own? Security analysis seems critical. Graham was famous for really digging into the details, wasn't he?
Oh, microscopically deep. The source shares that classic example of Northern Pipeline way back in 1925. The stock was trading around $65 a share.
Oh,
Graham did this incredibly exhaustive research, digging through obscure reports, and he found that the company was holding high-quality investment bonds worth $80 per share of stock.
wow, more than the stock price itself, just in bonds.
Exactly. So he had bought the stock, then actually advocated for management to distribute more of that bond income to shareholders. And eventually he sold his shares for $110. That's finding hidden value through pure, rigorous analysis.
So it's definitely not just that simple mantra you sometimes hear, buy what you know, without actually doing the homework?
No, the source cautions pretty strongly against that interpretation. Just because you like a company's coffee or use their phone doesn't mean it's a good investment at the current price. That buy what you know idea, which is often linked to Peter Lynch, really works best when it's combined with a Graham-like discipline. Digging into the numbers, understanding the valuation. The source gives counterexamples, like a company called AAA Enterprises, went from a $14 IPO price down to 25 cents. And bankruptcy, a familiar name or a good story just isn't enough.
What about those really hot stocks, the ones everyone's buzzing about, or new IPOs?
The source is pretty blunt here. For the average person, most IPOs and hot stocks turn out to be terrible investments. We get fixated on finding the next Microsoft, right? But that ignores the thousands upon thousands of hyped companies that fail or dramatically underperform.
And the gains in IPOs often go to insiders first.
That's right. Most of the big initial pop, if there is one, usually benefits the insiders and the big institutional investors who get in at the initial offering price. That's before the general public even gets a chance to buy. And day trading. The source basically calls it financial suicide. It's pure speculation masquerading as investing.
It really sounds like trying to predict the future performance of any single company is just incredibly difficult, unreliable.
It absolutely is. The source includes a pretty stark warning label about projections for individual companies having a very low degree of reliability. Forecasting the future for one specific business is just loaded with uncertainty. Graham himself was famously skeptical of overly complex math and valuation. He reportedly said something like, whenever calculus is brought in, you could take it as a warning signal. It gives this false sense of precision that just isn't there.
Okay, let's dive into some of the specific red flags Graham tells us to watch out for when we're looking at a company's financials. The accounting booby traps, as the source calls them. What are some key ones?
Right, the booby traps. Graham teaches us to be really skeptical, to look beyond the surface numbers. First big one. Never take a single year's earnings figure too seriously. Just 1 year. It can be managed, massaged, maybe even manipulated.
Look for consistency over time instead.
Exactly. And watch out for things like pro forma earnings or as if earnings. Companies sometimes report these alongside their standard results.
What are those exactly?
They're basically management's version of the numbers, calculated as if certain expenses didn't happen or as if they used different accounting rules than the standard ones, the generally accepted accounting principles, or GAAP.
It's like they're showing you the numbers they wish were true.
Pretty much. It's not based on the standard, comparable rules everyone else uses. The source uses Quest Communications from the dot-com bubble as an example. They use really aggressive revenue recognition, basically booking sales way too early before the cash was really secure to inflate their profits, had to re-steep massively later on.
Okay, so beware of non-standard earnings. What else should raise a red flag?
Be cautious with companies that are serial acquirers. Constantly buying up other businesses.
Buying growth instead of earning it.
It can be a sign of that, yeah. Or sometimes trying to hide problems in the original business. Buying more than, say, 2 or 3 businesses a year is often a warning sign. Companies like Lucent or Tyco back in the day had to later disgorge, basically sell off, often at a big loss acquisitions they'd overpaid for. It led to these chronic write-offs that just hammered shareholder value.
That sounds like it connects to the next trap mentioned, OPM addicts, using other people's money.
Exactly. Companies that seem overly reliant on constantly borrowing more money or selling new shares of their stock just to keep the lights on or fund expansion. Even if their core business isn't generating enough cash flow itself.
How do you spot that?
Look at the cash flow statement. If you see big, consistent inflows under cash from financing activities, that's borrowing or selling stock, it can be a sign the underlying business isn't self-sustaining. Global Crossing and WorldCom were classic examples.
Got it. And Johnny One notes.
Yeah. Companies that depend on just one, or maybe a very small handful of customers, for the vast majority of their revenue.
Risky.
Hugely risky. If that one big customer leaves or has financial trouble themselves, the supplier company is suddenly in deep trouble. Sycamore Networks was an example given at its IPO hype peak. Apparently 100% of its revenue came from just one customer, who later failed.
Wow. Okay, here's one I wouldn't have thought of. Unrealistic assumptions about pension funds, how can that distort earnings?
It's a bit subtle, but yeah. Companies with traditional pension plans have to estimate how much the assets in those plans will earn each year. That estimate affects how much pension expense they report on their income statement.
So if they assume really high returns.
If they assume unrealistically high returns, say 10% a year, when safe bonds are yielding 3% and the stock market outlook is uncertain, it artificially lowers the pension expense they report. And lower expenses mean higher reported earnings. It makes the company look more profitable than it might really be based on its operations. The source contrasted SBC's optimistic assumptions back then with Berkshire Hathaway's more conservative ones.
Sneaky. What about stock options for executives? How do they fit into these traps?
Well, historically, there was a big issue where stock options, while clearly a form of compensation expense for tax purposes, often weren't treated as a standard operating expense on the main income statement that companies reported to shareholders.
So reported earnings looked higher than they actually were.
Exactly. It distorted the picture. The source also makes a really interesting point about incentives. Executives who get a huge chunk of their pay in stock options might actually prefer actions that increase stock price volatility, like big stock buybacks, because volatility can increase the potential payoff of an option.
Whereas regular shareholders might prefer dividends, which tend to reduce volatility.
Precisely. So the executive's interests might not perfectly align with the interests of long-term shareholders who prefer steady dividends.
That's really eye-opening. It feels like you have to look way beyond just the headline earnings number. What about something seemingly simple, like a stock split? I always thought those were good news.
Graham would say that View treats investors like, well, gults. The source uses that great Yogi Berra quote. Cutting a pizza into 8 slices doesn't give you any more pizza than cutting it into 4.
Right. Same amount of pizza.
Same amount of company value. 2 shares priced at $50 are worth exactly the same in total as 1 share priced at $100.
Management often uses splits to generate buzz or maybe make the share price look cheaper and more attractive to small investors. But it changes absolutely nothing about the underlying business value. It's psychology, not economics.
It sounds like you need to stay vigilant, even with companies that seem incredibly stable and established. The source mentions the Penn Central Railroad bankruptcy. Yeah, that was a huge shock at the time.
Because they had paid dividends continuously for something like 120 years before suddenly going bust.
Exactly. It's a really stark reminder that even a very, very long track record of past performance is absolutely no guarantee of future safety. You'll always have to keep doing the analysis, keep questioning.
Okay. So with all these potential pitfalls and the need for deep analysis, how does a defensive investor, the one who doesn't want to be a full-time analyst, even begin to find suitable common stocks?
Graham has a suggestion for them too. He suggests looking for, and this is his phrase, relatively unpopular large companies.
Unpopular large companies doesn't exactly sound thrilling.
No, probably not thrilling. But the logic is sound. The market often gets overly excited about the glamorous, fast-growing stocks, right? Because their price is way up.
Yeah, the story stocks.
Exactly. Meanwhile, solid, stable, large businesses that are maybe temporarily out of favor or just in a less exciting industry get overlooked. Their prices might lag behind their actual value. That's where the defensive investor can find opportunities without needing brilliant forecasting skills.
So how do you find these unpopular but solid companies? Are there specific criteria?
Yes, the source lays out some straightforward quantitative criteria that a defensive investor can use as a checklist, basically, to screen for potential candidates. Things like the company needs to be of adequate size, large enough to be stable. It needs a strong financial condition, like having current assets, cash, inventory, receivables, things easily turned into cash at least twice as large as its current liabilities, its short-term bills.
Okay, a safety cushion there.
Right. And maybe net current assets greater than long-term debt, though market conditions change how applicable that specific ratio is over time. Also, a history of stable earnings, maybe some profit every year for the past 10 years.
Consistency matters.
Very much. And a consistent dividend record, maybe paid some dividend for the last 20 years straight. Demonstrated some earnings growth over the long term, maybe at least a 1/3 increase in earnings per share over the last decade, using 3-year averages perhaps. And critically, it needs to be selling at a moderate price relative to its earnings and its assets, its book value.
Moderate price. Are there numbers attached to that, like PE ratios?
Yeah, I'm suggesting some benchmarks, yeah. Like a price no more than, say, 15 times the average earnings of the past 3 years, or a price-to-book value ratio, that's the market price per share, compared to the company's net asset value per share of no more than 1.5.
Okay.
He even combined them sometimes. So the price-to-earnings ratio multiplied by the price-to-book ratio shouldn't be more than 22.5. Now, admittedly, today's economy has more intangible assets, things like brand value, which tend to make PB ratios naturally higher than in Graham's time. But even today, a PB around 2.5 might still be considered reasonable by many value investors.
So these criteria act like a filter. You run companies through this checklist and see what comes out the other side.
Exactly. It's what the source calls a winnowing approach. You might start with a really simple screen, like looking for stocks with a low PE ratio. The source notes Grant suggested maybe 9 or less back in 1970 as a starting point. Then you apply the other criteria, financial strength, dividend history, etc., to narrow down the list. The goal isn't necessarily to find stocks that will shoot the lights out. It's to ensure you're only considering buying solid businesses at prices that represent, getting your money's worth, protecting your downside.
That makes a lot of sense, focusing on the business value, not just the stock price chart hype. What about that other idea mentioned, finding stocks selling below their net current asset value? That sounds almost too good to be true, like finding dollar bills selling for 50 cents.
Like, it does sound amazing, and it can happen, though it was perhaps more common in Graham's era. This method is even stricter. He looks for companies where the stock price is less than the value of just their most liquid assets. Cash, receivables, inventory after subtracting all liabilities, both short-term and long-term.
So you're basically getting the land, buildings, equipment, everything else for free, or less than free.
Essentially, yes. The market, in its pessimism, is valuing the company at less than its breakup value, using only the most easily sellable assets. The source points out that sometimes, even well-known companies with household names could trade at these incredibly low figures. It really illustrates that, quote, attributed to Pascal. The heart has its reasons that the reason doesn't understand. And for heart here, you could substitute Wall Street. It just shows how irrational market pricing can get, creating these deep value opportunities for investors who are willing to look where others aren't.
Fascinating. The idea you could buy a company's cash and inventory for less than the stock price. Wow. Okay, moving beyond just common stocks and regular bonds, the source briefly touches on a couple of other investment areas.
Right, things like preferred stocks and also convertible issues and warrants. On preferred stocks, the main point is they generally have a more favorable tax status for corporate investors than for individual investors. So for an individual, they should probably only be considered if you can buy them on a real bargain basis, offering a significantly higher yield or potential appreciation than comparable bonds.
And warrants. They sounded like something to be wary of.
Very wary. The source calls them bad pennies sometimes. Highly speculative, often described as paper money monstrosities created in reorganizations or promotions. Generally best avoided by investors.
Okay. What about convertible bonds?
Convertibles bonds that can be converted into common stock under certain conditions can sometimes work out well. But the source suggests that often, if the company does well enough for the conversion to be profitable, you might have actually done even better just by owning the common stock directly from the beginning. It's a complex area, often more suitable for enterprising investors.
Got it. So with all this complexity, how does the average person navigate finding reliable investment ideas or figuring out who to trust for advice? It seems overwhelming.
It can feel that way. Sources of advice are everywhere, right? Friends, your banker, brokers, newsletters, professional advisors. Graham's fundamental view here is pretty clear. If you are going to rely on others for investment advice, you really have two main paths.
Okay.
Path one, you strictly stick to standard, conservative, broadly diversified investments. Things like index funds or maybe a very simple balanced fund. Minimal need for complex advice. Path two, if you want to consider less conventional suggestions, maybe individual stocks or more niche investments, you absolutely need to become knowledgeable enough yourself to be able to independently evaluate those suggestions. You can't just blindly follow.
So don't just trust someone because they sound confident or have a fancy title, especially brokers, maybe.
Well, the source is quite critical of relying solely on brokerage analysts. It notes they often face a conflict, feeling pressure to also be market forecasters, maybe analyzing with one eye on the stock ticker, as the phrase goes. And there's an inherent issue, isn't there? It's generally imprudent to place unquestioning trust in the judgment of someone who is also trying to sell you something, especially if their firm is underwriting the very stocks they're recommending.
That conflict of interest seems obvious when you put it that way. Are there practical steps you can take to check out a potential financial advisor?
Absolutely. You need to do your homework on them. Use resources from regulatory bodies like NASA, the North American Securities Administrators Association, or state regulators, or NASFIA for accountants to check for any history of complaints or disciplinary actions.
Good idea.
And the source suggests asking some key questions directly to the advisor. Like, how exactly do you choose investments for clients? Can you show me evidence of your past performance track record? Understanding past results don't guarantee future ones, of course. And maybe most revealing, what do you do when an investment you recommended performs poorly? If their answer is just automatically, we sell it, that's a major red flag. That's reactive, market timing behavior, not intelligent, long-term investing.
That's a great question to ask. Okay, what about mutual funds? It seems like you hear study after study showing that the average actively managed fund doesn't actually beat the market index over time, especially after fees.
That's overwhelmingly what the data shows, yes. And the source highlights this very clearly. The vast majority of funds run by professional managers who are actively picking stocks do not select them well enough to overcome the drag of their costs, the research costs, the frequent trading costs, and the management fees they charge.
And higher costs generally mean lower returns for the investor.
Statistically, yes. Higher expense ratios and higher portfolio turnover, meaning more frequent trading, are strongly correlated with lower net returns to the investor. In trying to pick the next winning fund based on which ones did well last year, the source suggests that's pretty much a fool's errand. It likens funds with consistent high past returns to mythological creatures like Bigfoot sightings are claimed, but reliably finding one in advance is highly improbable.
So if actively managed funds generally don't win, what's the alternative that Graham himself, and certainly Warren Buffett later in life, came to endorse?
Index funds. It's that simple, really. Index funds don't even try to beat the market. Their goal is just to replicate the performance of a specific market index, like the S&P 500, as closely as possible.
By just holding all the stocks in the index?
Essentially, yes, or a representative sample. Their crucial advantage isn't brilliant stock picking. It's their incredibly low cost. Minimal trading, no highly paid managers trying to guess the market. Because of that cost advantage, the source notes that holding a diversified, low-cost index fund for the long haul, say 20 years or more, especially if you're adding money regularly, is all but certain to outperform the vast majority of professional money managers and individual stock pickers.
All but certain. That's a pretty powerful statement. But even if someone picks a good low-cost fund, like an index fund, studies still show that investors often underperform the very funds they hold. How does that happen?
It comes right back to that core problem, doesn't it? Our own psychology. We tend to buy high and sell low.
Chasing performance.
Exactly. People pile into funds after they've had a strong run, buy near the top, and then when the market inevitably turns down, or that particular fund's style goes out of favor for a while, fear kicks in, and they sell near the bottom. The source cites one study showing investors earned, on average, something like 4.7 percentage points less per year than the reported returns of the very funds they owned, simply due to bad timing, buying and selling at the wrong times, driven by emotion. Selling a fund just because its style is unpopular for a bit is basically locking in your losses and guaranteeing you miss the eventual recovery.
Wow. It really does all circle back to controlling yourself, not trying to control the market.
It absolutely does. And the source kind of wraps up with this powerful testament to the enduring strength of Graham's core principles. It's what Warren Buffett famously called Graham and Doddsville, sort of an intellectual village.
What did he mean by that?
Well, Buffett observed, looking back over decades, that a remarkably, statistically improbable number of highly successful value investors all trace their intellectual roots back to this same origin, studying under or deeply absorbing the teachings of Benjamin Graham and David Dodd at Columbia University.
Way more than you'd expect by pure chance.
Far, far more. It couldn't just be luck. Investors in firms like Tweedy, Brown, Buffett's own early partnership, people like Stan Perlmutter, a whole cohort.
And what do they have in common, these Graham and Doddsville investors?
Despite having different styles, sometimes some ran very diversified portfolios, others were highly concentrated. They shared these core Graham-like traits. They fundamentally thought of themselves as buying pieces of actual businesses, not just trading stock tickers. They actively looked for and exploited discrepancies between the market price Mr. Market was offering and their own conservative estimate of the business's intrinsic value.
Margin of safety again.
Always. And because of that, they consistently operated with a much larger margin of safety than the average market participant. They were inherently assuming far less real risk. even if their results were sometimes spectacular.
Okay, so to bring this all back home, full circle, for you, the listener.
Intelligent investing, based on everything we've dug into from this foundational source, it really boils down to controlling the things you can control. You cannot control Mr. Market's daily moods. You can't control short-term price swings or interest rates or what the global economy does next quarter.
So what can you control?
You absolutely can control your own behavior, your emotional reactions, especially fear and greed. You can control the thoroughness of your own analysis or your rational decision to choose a simple, proven, low-cost method like indexing if you don't have the time or inclination for deep analysis. And critically, you can control the price you're willing to pay for an asset, insisting on that margin of safety.
And diversification seems like a huge piece of that control, a non-negotiable element.
It really is. It's probably the simplest, cheapest, and the most effective way to widen your margin of safety across your entire portfolio. It's the mechanism that ensures that any single mistake, a bad stock pick, an unforeseen disaster hitting one company is never catastrophic to your overall financial well-being. With diversification and that emotional discipline we keep talking about, the source reminds us of that old saying, no matter what turbulence Mr. Market throws your way, eventually this too shall pass away.
That's a powerful perspective to end on. Okay, so we've covered a lot today. The core principles of intelligent investing: patience, discipline, margin of safety, that critical difference between investing and speculating, the enormous impact of our own psychology being our biggest enemy.
Graham's different approaches for defensive and enterprising investors, practical portfolio ideas like the 50-50 split and using TPS for inflation.
Yeah, and how to actually look at companies spotting those accounting traps, finding value in maybe unpopular places, and understanding why simple, low-cost strategies like index funds often win out over complex ones in the long run while being careful about where you get advice.
It really is a timeless framework built on caution, solid analysis, discipline, and patience. It's much less about trying to be brilliant and much more about just trying to be rational and keeping your impulses in check.
So maybe a final thought to leave you with. If, as the intelligent investor so persuasively argues, the single greatest risk in investing isn't actually found out there in the noisy market or hidden in the financials of some specific stock, but it's actually staring back at you from the mirror every morning, then perhaps the most important, the most profitable investment you can ever really make isn't in any particular security, not a stock or a bond, but it's in that quiet, continuous, day-by-day effort to master your own mind and your own emotions.